Hello everyone, am I audible enough? Just can someone respond in the chat?
Yeah, can hear.
Okay, sorry, great, great. We'll wait for another 5 minutes until more people join, then we'll start the session. Okay, let's start our session today. Can someone let me know if you can see my presentation?
Yes,
Can see.
Okay, great. Okay, so with starting from today, I will be conducting these technical analysis sessions. I'm planning to cover everything in our course module within 8 sessions. So each session will be for about 3 hours per session, and we will be uh, starting with this most fundamental thing in technical analysis today, which is the doubt theory. And when it comes to technical analysis, it's somewhat, if you're not actually familiar with trading and technical analysis, this may be somewhat difficult for you to understand at first, right? Because these are like not familiar for you, right? And this is like there are some complex concepts in technical analysis, but once we are like becoming familiar with these concepts, uh, it will be sensible for you. So we'll be discussing these concepts throughout most of our sessions over and over again. So once it familiar, getting start to get familiar, it will become more easier for you. So we'll start the session for today. So I'll have to, introduce some basic things before we dive into our session today. One thing is that I'll be using technical trading view for our technical analysis sessions. So I recommend you guys to also log into this trading view platform. So if you are already trader in CSC, you might have access to a trade account. So can you guys please raise your hand if you have access to a trade, or if you are using trading technical analysis for trading, if you guys actually trading in the stock market. Okay, one. Okay, so I see some of you guys are actually trading. And are you guys using technical analysis for your trading? Okay, again, react if you use technical analysis for trading. Okay. Okay, I see one people has raised their hand. Okay, great. Okay, that's fine. So for the people who are actually currently trading in the stock market, they have access to ATRAD. But in ATRAD, you will have access to only the Sri Lankan stocks. So for all of you guys, I recommend you to use Trading View. So I'll show you how to access Trading View. First, you can just Google search Trading View and go to this platform. And if you are using mobile phone, there's an app in the Play Store and in both Play Store and the App Store. So you can also install the application, or you can use this web version. Yes, Mangalashan. Okay.
No, accidentally. It's accident. Sorry, accidentally.
Okay, that's all right.
Sorry.
It's okay. That's all. So this is the platform, right? This is the free version which I'm using right now. So you can also use the free version. That's more than enough. In this trading view platform, you can view any stock that is traded globally, any funds, futures, forex, crypto, indices. So including the Sri Lankan stocks and the indices, right? So it's much easier to use trading view for our technical analysis, and this is the most widely used technical analysis tool out there, right? So you can use this. Just create a free account. You can create so I'm already logged in through my personal account, right? You can also create a free account using your Gmail account or create a new account, whatever. Start to use this platform and just play with it and see what you can do with it. And I will be actually using this trading view throughout the session. And in every session, I will be using this because in technical analysis, the things that we learn are not just theoretical. So every theoretical concept that I will be explaining throughout the session, I will have to explain it using the real world charts, right? So we will be studying the real market situations with along with the theoretical concepts. So I will be using this trading view platform to explain every theoretical concept and how it translates to actual market behavior. Okay, so let me go back to my presentation again. So today, our session, throughout our session, I will mostly be covering the basic stuff. We'll look at what the technical analysis is, and we'll look at the difference between the technical analysis and the fundamental analysis. And we'll try to, cover most of the theoretical concepts in the Dow theory, because this Dow theory is the fundamental concept behind all the trading strategies and all the trading concepts we use today. So this Dow theory is actually very important, and all these concepts I will be explaining through the real market behavior. So and I will also be using a lot of technical words, technical language, right? So if you are not if you don't really understand something, feel free to unmute yourself and ask the question, or you can just drop a message on the chat. I will try to answer whenever it's possible, right? And yeah, so what is technical analysis? When we talk about technical analysis, we also need to talk about fundamental analysis. I think most of you guys are familiar with fundamental analysis. So what do we do in fundamental analysis? We look at the companies, their financials. We look at the economy as a whole and the economic impact for those certain stocks that we are looking at, right? And all those sort of things belong to the fundamental analysis, right? The ultimate goal of the fundamental analysis is to get the value of a share, right? So to arrive at that valuation, we do company valuation, right? We use multiple, we use multiples, we use valuation concepts like these discounted cash flow methods, we use residual income method. So there are valuation methods that you can arrive at a value of a share. So value is something different to the price, right? So if I say, so this pen right here is not worth, it's actually the market price of this pen would be around 200 rupees, right? But it's more valuable to me right now, more than 200 rupees, because I'm writing it, right? I use this to write right now, right? So it will be more valuable to me right now than the market price, right? So you get what I'm saying, right? The market price is something different than to the value. So in shares, the value of a share does not necessarily mean that the price should go there, right? In fundamental analysis, the ultimate goal is to get that value per share. So to get to that point, we use the economic analysis. We look at the company business quality, we look at the financials, and we look at the economy as a whole and try to understand the value of a share. In technical analysis, we don't look at the valuation. We actually look at the market price, right? We look at the market price action. We use technical indicators. We use volume indicators. These are some examples for technical indicators. The main one we use is the volume indicator, right? And we also use charting patterns. We also use candlestick patterns. So those are some technical analysis tools we use to sort of analyze the market, and our final goal is to arrive or decide where the market is moving next. So here you can see the differences, right? The core question in fundamental analysis is what should the price be? In technical analysis, we are looking at the current price behavior, we are looking at the past price behavior, and we are sort of predicting the next move, right? And through the fundamental analysis, we get a sort of direction where the price should be. But in technical analysis, we can actually get an idea as to where should we enter to the market and where should we exit from the market. So basically, I'm just saying at what price we should buy a certain stock, at what price, at which price we should sell a stock. So those questions are answered in technical analysis, right? And the fundamental analysis, like mostly focusing on the medium term to long run. By medium term, I mean when we look at the analyst or the stockbrokers, company initiation reports, they give price targets for about 1 year, right? So medium term means 1 year, the long term means more than 1 year. So in the fundamental analysis, the focus is on the medium to long term, right? Whereas in the technical analysis, we mostly focus on the short term to medium term. By short term, what I mean is we can actually look at even in the 1 minute time frame in technical analysis, right? Not just 1 minute, we can look at 5 minutes, we can look at 15 minutes, 30 minutes, 1 day, 1 week chart, yearly charts. So based on those time frame analysis, we can actually, sort of predict where the market is moving, right? So the main focus in technical analysis is the short to medium term, right? I personally trade in the short time frame. I only trade world futures. So I sort of look at the 1 minute time frame, 5 minute time frame, like very short time frame, right? So if you actually want to become a good trader, this technical analysis is something that you should learn very well, right? Even for the like, if you are like a retail investor, just wanting to become a good trader, technical analysis is very important, right? Okay, so the primary users of the fundamental analysis are the institutions, right? Equity analysts and value investors. And in technical analysis, it's used by traders, mostly day traders, and institutions also use like hedge funds and portfolio managers. So it's very effective if you use fundamental analysis along with the technical analysis. If you combine them and make your investment decision, that would be very efficient, very effective. So it's always recommended to use both fundamental analysis along with the technical analysis before making a investment decision. Okay, so until that part, I think you should understand now the difference between the fundamental analysis and technical analysis. I guess you also have programs covering fundamental analysis side of things. So in this, you can also, get to know the technical stuff and make more sound investment decisions. So we also earlier looked at the user groups of the technical analysis. Mostly traders use it, portfolio managers use it, analysts, retail investors, they all use it. So the ultimate value behind technical analysis is that we can sort of predict the market, right? We can sort of, say where the price is going next. And we it's like very, it's like a superpower. You get to know where the market is heading next, right? It's actually useful if you are a trader. And this technical analysis works in very liquid market, not very liquid, it works in liquid markets. It doesn't work in illiquid markets. By liquid markets, what I mean is there are higher trading volume, right? And there are a higher number of market participants. So if you look at, so the liquid markets usually have like very high market capitalizations. So if you look at within the Colombo Stock Exchange, there are like low market cap stocks. So they are mostly liquid ones. If you look at like Commercial Bank, JKH, they are like very liquid ones. So that technical analysis works in those charts. And even by looking at a chart, you can say if this market is liquid or not. So let's look at an example. So can one tell me what is the highest market cap stock in Sri Lanka? Any
Currently
answers?
dialogue, isn't it?
Sorry?
Dialogue.
Dialogue at the moment, I think.
Okay, dialogue.n. Right, that's the ticker, right? Is it a dial.n? Dial.com. Okay. So I guess you guys know the difference between the .n and .x. So .n ticker means these are the voting shares. .x means these are the non-voting shares. So we will be looking at the voting shares because these voting shares are traded at a higher price than the non-voting share. Because from the name you get it, right? Voting shares means they have the voting power. Non-voting shares means they don't have the voting power. So it's common to trade the non-voting shares at a higher price than the non-voting shares, right? Okay. So when you look at, so I'm going to change. So in trading, you can actually change the tickers from here. Any Sri Lankan stock, you can find it if you know the ticker name, right? And you can also, I'm just explaining some of the, interface within the technical analysis. So you can also play with it and be more familiar with this interface. It will be useful for you, right? So here, what you can do is you can change the time frame. And here you can also change the candles or the chart type. So right now I'm looking at a candlestick chart. So we will actually learn all of these things in detail in next session. So don't worry about it right now. So for now, I will leave the chart in line. So it will be more easier for you to understand. Actually, so now the goal is to identify the liquid markets and the illiquid markets, right? So I actually have to use the candlestick chart to do that. So if you look at the candlestick chart, it is something like this. So this is a liquid stock, right? And you can also add a volume indicator from this indicator tab. Right now I'm adding the volume indicator. So here you can see the volume and the candlestick chart. So from this chart, it doesn't, doesn't look weird, right? It is just a normal candlestick chart. So we'll also look at another illiquid chart, right? So I'm going to look at the components of ASI. And I'm going to select a company with very low market cap, right? So these are the components in SPI, right? The ticker for SPI is ASI in TradingView. So this is the Colombo Stock Exchange All Share Price Index, which is representative of all the shares that are traded on the CSE, right? So these are the components. If you sort it from the market cap, right? You can see here from the largest market cap to the lowest market cap companies, right? Dial.n, which is Dialog's non-voting shares, are at the top right now. And if I sort it from the lowest market cap, it would be like this Blue Diamonds Jewelry Worldwide, those companies. So we'll look at this Blue Diamonds chart, blue.n. You see the difference, right? In the candlestick chart, you see the difference. So there's no there's no wave pattern. There's no it's not actually even going up or down. It's just moving in the same price range. It has moved from 0.4 to 0.2 for a long time, right? So these are the illiquid markets. So you can't actually do a technical analysis for this sort of charts because they are illiquid. The market can move in a certain direction without respecting any technical concepts. That's what I mean by we can't use any technical concepts in those illiquid markets, right? And if you see this candlestick charts looks very weird, right? You can't even do a technical analysis on those type of charts. So I'm going back to my presentation again. So we were discussing about the applications of technical analysis where we can actually use technical analysis, right? So I was saying we can only use technical analysis for liquid markets. So those liquid markets, by liquid markets, what I mean is that those markets have higher trading volumes, higher number of market participants, and also they usually have higher market caps, right? And we can also use technical analysis for any financial instrument, right? If a price chart has, if there's a liquid market with price history and volume history, then it might have a good candlestick chart. And for all those markets, we can use technical analysis. So it can be a forex instrument, it can be a stock, it can be commodities like gold and oil, it can be crypto, it can be any derivative, right? I'm going back again to my trading view platform, and I'm just browsing through all these options we can trade by knowing these technical analysis concepts, right? So these are just stocks, right? These are funds, futures, right? Forex. I have just searched blue. So these are all the stocks around the world. These are futures. These are most commonly traded futures that comes in the first, right? It's actually sorted from the most traded companies to the lowest trading companies. Not just companies, sorry, futures. We can also trade like Euro USD, foreign currencies, GBP USD. Those are very, very, very liquid markets, right? The technical concepts mostly actually works very well on those markets. This gold is like one of the most liquid markets in the world, right? Gold futures or gold spot. So I will be actually using this gold chart to explain a lot of the technical concepts that we will be covering throughout the day, right? Okay. So as I said earlier, if you have a sound knowledge in technical analysis, you can use that knowledge to trade any financial instrument that has a price history and volume history. So that includes equity markets, forex markets, commodity markets, cryptocurrencies, derivatives market. For any of these financial instruments, the technical concepts are the same. They don't actually change, right? Okay. So in technical analysis, there are like few assumptions, right? Every concept is based on these three assumptions. First one is the market discounts everything. By that, what I mean is the price of the market is, the price actually depends on two things, right? The price is dependent on demand and supply. The market price is dependent on the demand and supply, and it is influenced by the other factors. But ultimately, the price, a market price of a share or any financial instrument is dependent on the price. And this price reflects every publicly available information, right? So for example, when a company like discloses better than expected financial results for a quarter or an annual basis, that will move the prices up for that particular stock. And another recent example I can give you is the NDB fraud, right? So you guys must have know that fact, right? So in recently we had a fraud in one of the most prominent banks in Sri Lanka, which is NDB. And when they have disclosed, as soon as they have disclosed that the fraud happening in their bank, the price like very quickly crashed. So we'll look at the stock. Can one of you let me know when this was first disclosed, the fraud event for the NDB bank? Just quickly check and let me know when the news broke out. Okay, the fraud was first disclosed in April 2nd of 2026. So we'll look at the price chart of NDB Bank, right? This is the NDB voting share. The fraud was first disclosed in April 2nd of 2026. April 2nd. So here in technical analysis, the chart in this chart, these are the prices. I'm just letting you know, guys, who are not familiar with this uh, charting thing. So this on the right hand side, you can see the price, right? This is the price of the NDB bank. This is the time, right? So if I like point into uh, some of the axis here, you can see the date is moving from the below, right? This is Friday, 7th of November. On the chart to the right side, that means we are arriving at the current dates, right? And you can also change the time frame in TradingView from here, right? So right now I'm looking at a 1-day chart. I'll again move into this, change it to the line chart, so that would be easier for us, right? Okay, so now I'm going to point you to 2nd of April. 2nd of April. Okay, so this is actually 5, 6, no, 16. Okay, so this is the date where it was first disclosed that about this fraud event. You can see the price, how the price has tanked during that day from the 2nd of April. So we'll just try to measure that. So there's about 15% decline of that stock by the 8th of April. So the news was disclosed in 6th of April, and by the 8th of April, the stock has tanked by 15%. So our first assumption of technical analysis is that price reflects everything that is publicly available. That means whenever public gets to know any news about any positive news, any negative news, that will be reflected on the current share price, right? That is our basic assumption in the technical analysis. Our second, and also, well, let's start to look for another example. Can someone tell me another market moving news that happened recently? Just, you can drop a message on the chat. Just tell me any market news that happened recently. Any market moving news, like any war situation, like anything that has had an impact on the market. Okay, Middle East war. Okay, so let's start to find the starting date of that Iran conflict, Iran war. starting date. The 2026 Iran war began on 28th of February. Okay, we'll look at how the Sri Lankan share market reacted on that day. So the main index of Sri Lanka is the All Share Price Index, and the ticker for that is ASI in Trading View, right? So I have selected ASI, and now I'm looking at the ASPI index. So this is reflective of all the share prices that are traded on the Colombo Stock Exchange, right? So when was the war started? Okay, 28th of February, 28th of February, 28th of February. 28th of February. 28th. This is April 28th. Okay. So 28 is a holiday, I think. So 27 is a Friday. 28 is a Saturday. So probably the market is closed on Saturdays and Sundays now. So the next market opening days was this, right? After the Iran war broke out, the market has gone down for about I'm measuring till 19th of March. Actually, the war is still going on now. So we can't actually just rely on that. But anyway, the market has reacted for that news by this decline, I think. This is just the immediate decline. So what we can actually use is the gold chart, because gold is considered as one of the safe haven assets in the world. In any event of a market uncertainty, gold price goes up, right? So we'll look at gold, how the gold reacted on that particular date, because the impact on Sri Lankan market will be less. The immediate impact will be less from the Iran situation, because we don't have any direct impact other than the fuel. But now that is impacting us, right? But it's not for gold. So for gold, it's like they are like immediately reacting for these sort of things. So again, I'm just looking at the gold chart. I'm trying to assess the market impact on gold on 28th of February. Let's look at 28th of February. Okay. Okay. This is also a holiday. So during the holidays, the impact will be less. We'll look at, I think the date should be different. The impact should, because of it's a holiday, the impact can be on a different date. Widely recognized as 20. Okay, in gold also, we don't see a major impact from that Iran news. Or maybe the impact news came on a different date. Maybe around here, from here, we might have seen the escalating situation before it broke out. Because of that, the market maybe reacted on a different day. So anyway, what I'm trying to say is any publicly available information is reflected in the share price. That's our basic assumption in technical analysis. So we will next move on to the second assumption, which is prices moving trends. In technical analysis, it is actually the real situation is the price is not moving in a single straight line. It does not move like this, right? So the prices are not moving in a single straight line. You can see here the market price is moving in waves. It goes up, it goes down a bit again. goes like this. It goes up, it goes down, it goes up again, it goes down again, up, down, up, down, up, and so market moves in waves. It does not go up and up again and again without just having like slight pullbacks. It is not the way it is. It goes in waves like this. So this creates trends. So there are three types of trends in the market. We will discuss about these trends in very detailed sessions. Probably in next session, we will be able to discuss about the trends, right? Until then, I'm just sticking to these assumptions. So our second assumption was that price moves in trends, right? It does not move in a single straight line. It moves like waves, right? And our third assumption is history repeats itself. The main reason why we learn technical is to understand the past price behavior, right? And then understand the present price behavior and try to predict the next price. So it's also not just in stock. So that's why we learn history as a subject in our schools, because we know that history has a tendency of repeating itself. By technical analysis, also, we are trying to learn that because there's a tendency of history repeating itself again and again, right? Basically, the market price, as I told earlier, is dependent on price. So market price is dependent on demand and supply, and that price is shaped by the human emotions. So when it comes to the stock market, there are like 4 human emotions. One is the fear, the second one is the greed, and then you have regret, then you have hope. So fear is when fear can be, if you're holding like a large position and now it's losing value in day by day, you have fear, right? You feel like you need to sell. And if you're holding that losing position for a long time, you might also feel regret, right? You feel that I should have sold this position a long time ago, right? That's regret. And you also have fear. So those can be happen in the market, and those are like very predictable human behavior. And on the other hand, you have greed. So let's say if you are on a winning position, you are holding a stock that is going up and up day by day. Now you have got a return about, let's say, 20%, but you have greed. You are still holding on to that position because you have greed. So these are like, and you also have hope that it would go up, right? And if you are in a losing position, you hope that it would go up. If you are in a winning position, you hope also then again it would go up, right? It would go up more. So those are like very predictable human behavior. So those emotions also shape the supply and demand dynamics, and then it will also be reflected in the price itself, right? And these predictable human behavior and this demand supply dynamics create a price chart where we can actually analyze using technical analysis tools. By doing that, we can predict the next market move. So that's what we are going to learn. So this Dow theory is as I told earlier, it is the most foundational concept in technical analysis. So this is actually a concept that was first introduced in 1800s. A person named Charles Dow, right? I think he couldn't complete that Dow theory, so his associates have completed it. But anyway, this technical analysis is not a new thing. So it has been there for a long time, right? It has been there since 1800s, right? So there are this Dow theory has reshaped into many like modern technical concepts that we use today. So it's important to understand the basic principles of the Dow theory. So there are like 6 principles in Dow theory. We call them tenets, right? Those are principles in Dow theory. There's no particular order for that 6 principles, but you need to know all of these 6 principles in order to understand modern technical concepts and trading strategies. Okay? And in the meantime, I also want to ask you guys to just install TradingView if you are using a mobile phone. If you are actually logging in through a laptop, you can use the web version, right? As I use it here. So because I will be using TradingView to explain all these 6 principles in Dow theory, right? As I told before, we have these 6 principles and concepts that I'm going to go through each tenet. I will be explaining it through real world charts. Okay, so let's look at the first tenet, right? So the first tenet or the principle in Dow theory is that market has 3 movements, right? The first broad move, we call it primary trend, right? Primary trend can be lasting from 1 to 5 years. So the primary trend is something like a long-term trend, right? It will be very visible on the price charts, and it can last up to 1 or 5 years. So that is the long-term time frame we can see on any price chart, right? And there will be secondary trends. Secondary trends means these are like secondary trends. Primary trend is the broad price movement that we see on the long time frame, and there will be secondary trends within that primary trend. So these secondary trends can be going from anything from 3 weeks to like 3 months. So it can be range from a medium time frame, right? So we'll actually look at one example. So I'm going to go to TradingView again. I will clear this chart first. Okay. Now I'm going to look at the weekly chart. Right? I'm changing the time frame to 1 week. Right? That means each point will represent 1 week. So here I'm moving. So if I just click on here and move from one point to another point, it will be a week, right? So right now you can see the date on the below, right? Here you can see the date. This is the date, 11th of September. If I move from this point to another point, that is 18th of September. So that is a week. Again, I move to the right hand side by 1 point. Then it will be 25th of September. So that means each point represents 1 week. But if I change to the daily time frame, then it will represent 1 day by each point. Right? So right now the date is 30th of June. If I move by 1 point to the right hand side, it will be 2nd of July, because that was I guess it may be honest. So if the next day after the 1st of July, 2nd of July, then 3rd of July. So each point represents a day, right? So like that, you can change the time frame from this area right here. So right now, what I'm going to look at is the weekly time frame chart. Right? So this is gold spot chart on the weekly time frame. And our primary trend would be anything that will range from 1 year to 5 years. So if you look at the price trend for the last year, so we are in 26th of 20 July of 26 now, 2026 now. So we can go to July of 2025. This is July of 2025. And we can actually extend more, right? Because the primary trend can last from 1 to 5 years. So I'm just selecting random point from here to here. So this would be a primary trend we are seeing here. This would be the primary trend. It is an uptrend. So another thing you need to understand is how to identify the trends. So there are three type of trends in the market. We have another session for trend discussion. We will be doing that in the next session. But for now, I'll just explain. We have three trends. One is an uptrend. You need to know these three type of trends before we are actually explaining this Dow theory. So uptrend is characterized by higher highs and higher lows, like something like this. So here, if you look at the price here would be 4,320. This is considered a higher high. I'll just put HH, right? And if you compare to this point, this 4,320 area to this point, this will be another higher high. This is the higher low, that is higher low. And compared to this point, this will be a higher low. So an uptrend is something like this, where the market is continuously going up and giving higher highs and higher lows. This is what we call an uptrend. Right? A downtrend is completely opposite. Downtrend is something like this, where the market is giving lower lows and lower highs. Sorry, lower lows and lower highs. Something like this. Right? So a lower low would be this. A higher low would be this. Compared to this point right here, this is another higher low. This is a lower low compared to this point. So you can see that price is also going in a downward trend. Price is declining continuously, and the market is giving higher lows and lower lows continuous. So that is a downtrend. So the other trend what we have is the consolidation. It is something like this sort of sideways action where the market moves in a certain range, right? Like this. This is a consolidation. So these are the three types of trends. We will discuss these trends in very detail in our next session. But for now, just keep an idea of what these trends mean. That you can also look at the prices here. The price would be the same range in a consolidation phase. I'm going to just move this to here. We going. Okay. Okay. So I guess now now you should get a basic understanding of what these three type of trends are, right? And I just delete this, otherwise it's not clear. Okay. So what we were discussing is that the first principle of Dow theory, right? The first principle is that market has three market movements, right? The primary move is the one we see on the long time frame. So that can be anything above 1 year, most ranging from 1 year to 5 years. So in gold chart, you see the higher highs. The market is continuously giving higher highs and higher lows. So this is the lowest point. It moved here, then it moved here, it moved again here, it moved again here. Higher high, another higher low, higher high, higher low, higher high, higher low, higher high, like that. So this is clearly an uptrend. So this is our primary trend on gold, right? So what is the secondary trend? Secondary trends can be anything that is ranging from 3 weeks to 3 months or maybe 5 months. Like those are the waves within the primary trend. So these are, so I'm going to mark it here. So these are the yes. So these are the secondary trends, right? You see a downtrend here, right? So that is ranging from March of 2023 to October of 2023, right? That's about maybe 5 months, right? 5 or 6 months. So that is a secondary trend. Again, you see a lot of secondary trend. This is another secondary trend, right? This is a secondary uptrend, right? Another secondary trend. Like that, we see three market movements like this. So our primary trend on gold is the uptrend, which we see from here to here. And within that primary uptrend, we see secondary trend ranging from about like 3 weeks to, it can range from 3 weeks to many months, right? Like this one, these are the secondary trends. Those are within the primary trend. And within these secondary trends, there can be like very small fluctuations that happen on daily basis. So I'm just going to remove all of this stuff, right? And I'm going to move to the daily market, daily time frame. Right? Now I'm watching the chart on daily time frame. That means each point represents 1 day. I'm going to change the chart type to candlestick. So that will be easier. So now I'm looking at the daily chart. And you can even actually narrow it down furthermore to like 1 hour, 4 hour, right? Now I'm looking at the 1 hour chart. So each candle represents an hour, right? If I move from here to here, you can only see the difference in the time. Here the time is 4:30, here time is 5:30, but the date is same, right? 11th of June, 11th of June, but the time is different, 4:30, 5:30, 6:30, like that. Each candle represent an hour. So this is an hourly chart, right? So within a day, a lot of things can happen, right? So let's look at the last market open day. It was Friday, right? Friday, 12th of June, right? So this is the market move that happened on the Friday. So these are called minor trends. This is a consolidation actually. On Friday, we saw a consolidation on 1 hour chart. But if you narrow it down further, you can also see it's still a consolidation, but you can see a trend, right? That is the trend is the consolidation. So Friday, what we saw was a consolidation. So these are minor trends that are within the secondary trend, right? These are very short-term price fluctuations that happened on daily basis. In Dow theory, we don't actually, we don't prioritize this short-term price fluctuations because in Dow theory, we are focusing on long-term time frame. Because when it comes to when we look at the limitations of Dow theory, you will actually know this. We can't actually rely on Dow theory for very short time frame analysis because it focuses on the like somewhat longer time frame, right? So these are called minor trends that and these trends are like noises. These are considered noises in Dow theory. Noises mean you understand, right? Noises mean these are not really that important for long time frame analysis, right? Again, I'm going to explain that, right? We first look at the gold charts, weekly chart, and what we first try to do is understand the primary trend. What do we call a primary trend? Any long-term direction lasting 1 to 5 years. So primary trend on gold, you can mark it like this. So there's no right or wrong answer for this, right? So it is very subjective. So as when we say primary trend can last from 1 year to 5 years, you can also mark something like this. This as your primary trend. And another one, this as a primary trend. So these are primary trend. As a technical analysis, what you need to do is first thing you need to do is understand the long time frame bias. That means you need to identify the primary trend, right? So we identify the primary trend on gold chart. I chose a point from here, and from this point we are seeing continuous higher highs, higher lows, higher highs. It's an uptrend, and that is our primary trend. This is our primary trend. Right? This whole thing is our primary trend and it's bullish. Right? Bullish market means when the primary trend shows the price is continuously going up and up, we call it a bullish market. Right? When the price is continuously going down, we call it a bearish market. That means the primary trend is a downtrend. Right? If the primary trend, again I'm saying, this primary trend is a uptrend, so we call it a bull market. When the primary trend changed from a uptrend to downtrend, that is a bear market. So here in gold, actually, you can see the trend has changed, right? We will actually discuss how to identify the trend reversals in next session. Okay, so I'm not going to explain that right now, but the trend has changed from this point to a downtrend. So if the price is continuously going down and down again from this point, that could be that we explain it as a bear market. So here we just pass through a bull market in gold, right? Where the price is continuously going up and up again. And that is reflected in its primary trend, which is an uptrend. Within this primary trend, there can be secondary trend. So this is a secondary trend. This is a secondary trend. There can be multiple. So there are like a lot of secondary trends here. So anything that are within the primary trend that can last from 3 weeks to many more months, it is considered a secondary trend. These are secondary trend. I'm just going to mark it as SP. So all of these are secondary trends. And if you narrow it down to daily time frame or hourly time frame, you can see the minor trends like this. But those are within like very you cannot actually beat the whole primary trend when you add 1 hour time frame because the time horizon is long. If you are on 4 hour time frame, you can see the minor trend here, right? But let's look at let's mark a minor trend within this primary trend. So anything that happens on daily basis is a minor trend. So right now I'm in the 4 hour chart. That means each candle represents a 4 hour time frame. So I move from here, the date won't change, but the time will change. So this is what happened on 5th of December 2025. Right? The time is changing by 4 hour by 4 hour. Right? So within this day, we have seen price trends. I mean, anything like this, whatever happens on a daily basis, we consider that minor trend. And that are considered noises. Right? Minor trend. We also call it noises because these are not important for long time frame analysis, right? If you are like trading on the short time frame, we need to look at these time frames as well. In Dow theory, they are not really focusing on the long time frame. So these are considered noises. Okay. Any questions so far? Is it difficult to understand for you? Any comments?
Not sir, it is understandable. Thank you. But the thing is, some noises has a direct impact for a long term. Also, right? Can we distinguish between those noises, what are important for a long term impact? No,
Okay.
noises create the long term. My understanding, I don't know whether it is correct. If you go for a small spectrum, 1 minute, which is we are talking about yearly basis also. The theory is basically based on long-term analysis of
Yeah.
charts, but the small impact aggravates the long-term impact. If there's any mechanism to identify those things.
Yeah. Good question. So that's a good question. So there are like lot of trading concepts as I told before, right? And you can just call me Rangika, no need to call me sir. Just call me Rangika, right? So what I was saying is the short time, what you are saying is that short time frame impact can unfold to a long time frame impact, right? Is that correct?
Technical difficulty, I think I can't hear. It is, I think.
Okay, so I was saying what you are saying is that short time frame impact can unfold to a long time frame impact, right?
Yes, sir.
Okay, just call me Rangi. No need to call me sir.
Right.
That's okay. Okay, so in Dow theory, this is like a very old trading concept, right? So this was founded in 1800s, and we are just only looking at this to understand the basic principles within the Dow theory because it has shaped the trading concepts that we follow today. So I'm actually trading on 1 minute time frame, mostly on 5 minute time frames, right? So I don't actually use this Dow theory, but I actually need to know the higher time frame bias before moving on to the short time frame trades. So this Dow theory is important in understanding the long time frame bias, right? But it does not, give meaningful impact to your short time frame analysis. So you need to, look at other stuff, other technical tools, and combine with these technical indicators and all sort of things to understand the short time frame price movements. So this is just a concept, and the main thing here is these minor trends are considered noises in Dow theory because this is not important for long-term time frame analysis, right? If you look at a chart like gold, okay, wait. Can you see my chart?
Not yet.
You can see it. Hi. Okay, so what I was saying is, if you are like a long-term investor in gold, I'm just going to again remove all these indicators and drawings.
Excuse me, sir, we can't see your chart.
Okay. Is it visible now?
Yes, now okay. For me, it is okay.
Okay. So in Dow theory, we are focusing on the long time frame, right? And if you are like a long-term investor in gold, we already know that the gold prices are going to go up because it's an inflation hedge, right? The market views gold as a safe hedge against the economic uncertainties, against like any sort of uncertainty. It will be reflected on the price in gold prices, right? That's why if you look at a from very long time frame basis, you can see a clear uptrend, right? So this is right now I'm looking from 2022, right? From 2022, the gold price has gone up about 220, 233%, just approximately. This is from 2022, right? You see the primary trend as an uptrend, right? And in this uptrend, the minor like downtrends, minor uptrends are considered like they are not really important. Those are noises. And that's what I mean by that these noises are not very impactful for the long time frame analysis. What you need to do if you're like long-term investor, what you need to look at is the long time frame, right? If you're like a short-term time frame trader, you need to look at the short time frame. So I'm trading on 1 minute chart. I don't need this. What happened within a year, what happened during the past 10 years, I don't need that. But I will need to understand the long time frame bias, and I can zoom into short time frames like 1 minute charts and identify the trends within those charts, right? If you look at this is this is 1 minute time frame, and you can see another downtrend here. These are noises in Dow theory, but what I use is these noises. The day traders are the people who trade on the noises. Noises means minor trend. but these are the time frames that the day traders use. So it's really important to understand these minor trends. So we will discuss the technical concepts that will be helpful to do this short time frame analysis as well. For right now, we are just looking at this Dow theory, which is for the long time frame analysis. So just don't generalize it for short time frame analysis, right? We will discuss those things. We will try to go through at least few more trading strategies that we can use in short time frame. But just don't rely on Dow theory if you are trading on short time frame, right? Just get the basic concepts and the understanding of the Dow theory. Okay.
Thank you, Mr. Ang.
Okay. So we'll move to the. Do you guys need a break? Short break, maybe for about 15 minutes. We can take a break. I will end the session at about 5:30. So I think we'll get a short break. In the meantime, if you have any more questions, you can unmute yourself and ask, or just drop a message on the chat. Anything is fine. You guys can take a break if you don't have any questions. We'll catch up again at 4. Okay, we'll start again. So we were discussing about the Dow theory, and we were discussing about the first tenet, which is the market has 3 movements. The primary trend is where we see the long time frame trend. When the long time frame trend is giving higher highs, higher lows, that is an uptrend, and it is considered a bull market. So when the long time frame or the primary trend is giving lower highs, lower lows, and continuously the price is declining, that is a downtrend and it is considered as a bear market. So we looked at the gold chart, right? We looked at the gold chart and we identified the primary trend like this. This was our primary trend. Within that primary trend, there are secondary trends like this downtrend right here and this uptrend right here. Like that, there are secondary trends within that primary uptrend, and within these secondary trends, there are minor trends which are happening on daily basis, which can occur, short time frame fluctuations, which is actually not that important in the Dow theory. Okay, so in Dow theory, we are focusing mainly on the long time frame analysis. So I'm moving on to the second principle of Dow theory. These three phases of a primary trend, right? So I told you guys before that there are two types of primary trend, which is the primary uptrend, and the other one is a primary downtrend. Primary uptrend means it's a bull market. If it's a downtrend, it means that it's a bear market. So these phases, we have different names, different three names for both types of primary trends. In bull market, we have accumulation, public participation, and excess. These are the three phases in a bull market. We have distribution, public participation, and panic phase. These are the three phases in a bear market. So we'll also try to identify these on real charts. I'm again going back to gold chart, right? So this was our identified. I'll just extend it to this so that I can explain the three phases of the primary trend much better. Okay. So I'm again. How do I highlight this? So I'm going to draw vertical lines, right? So from this point and to this point, I consider this is my primary trend, which is a bull market, and we can identify this because it has been giving higher highs, higher lows, higher highs, higher lows, higher highs, like that, right? So this is my primary trend up to from this point to this point, right? And within this primary trend, now we are going to identify the three phases of a bull market. So this is my bull market. Right. Okay. So usually in a bull market, according to Dow theory, we identify three phases. One phase is the market interest is very low. That we call is accumulation phase. From this point, you don't see any major market movements, right? The price has been trading sideways within this small price range, right? If you look at the price, this price point is 2,422. This price point is 2,308. So the market has been trading in this range for about, I don't know, maybe 2-3 months, from June to April, June, May, June, about 2 to 3 months, right? So this was the accumulation phase of our primary trade. This is accumulation phase where the market don't make any like significant moves, and the market participants have less interest in the market because market is moving sideways. No one is interested in buying gold at this point, right? And this is called an accumulation. But for informed investors, this is actually the phase they should enter, because after that you are not going to catch very high returns like you can during the accumulation phase. So for informed investors, this accumulation phase is their entry, right? This gives them the best chance to enter the market. Even here we say informed patient investors begin buying against prevailing pessimistic sentiment. Prices move quietly, right? Prices are moving sideways. Market is less interested, but informed investors make that an opportunity for them to accumulate gold, right? They are buying at this price range when the market is very less interested. They will have very less interest in the gold. After that, we start to see some movement in the market like this. Or you can actually consider this range as a public participation phase. So there is actually no right or wrong answers in this. Okay, so this is a very uh, subjective concept. So I'm just explaining this could be a market participation phase. There's no right or wrong answer. You can also say this is the market participation phase. But anyway, it is very subjective. You know? So I'm just considering this as a market participation phase, and this is where the public enters into the market, right? Lot of the retail investors enters the market at this point, because when the price is starting to move, there's going to be news coming out, right? The gold has moved 20% within a day, like that. There are news coming into the market, so now the retail investors are interested in gold all of a sudden, and the market is going to, like, react very quickly. They are going to, the retail investors going to join. So that is our market participation phase. So this can be our market participation phase, where we see some movement in the market, right? I think I also have an example. Okay, so we'll look at this one first. So this was the accumulation phase, where the market is where the market don't have any interest in any financial instrument. In this case, gold, right? But this is where the informed investors should accumulate the financial instrument, or in this case, gold, right? Then we are starting to see some news coming to the market that the gold is moving, and when that happens, the retail investors start to join the move, and it will push the prices even higher. So that phase is called the public participation phase. In this case, I have marked this as our market participation phase, or you can call it public participation phase, right? The next phase is the excess phase, right? This is now where the movement get more intense, and the price even push higher, right? Like this. This can be our excess phase. After this brief consolidation, when even up to this point, from this even with this consolidation phase, we can consider this whole area as our market participation phase. After that, we see the excess phase. This is where the market move is more intense, and lot of, so here also the retail investors are entering the market. Here also the retail investors are entering the market, but institutions are less likely to enter at this phase, because they are very informed than the retail investors. So usually retail investors are not entering at this excess phase, and the informed investors are starting to sell their position in this phase, right? This is the excess phase, where the market move is more intensified, and from this point, okay, give me a second, guys. Okay, the attendance bar is didn't showing in elements. Is that same for you guys? The attendance bar, is it visible on the LMS?
Yes, I had done it. No problem with the previous password is the same. No problem to me. I don't know others.
No, I can't access that.
Okay, we'll see about that later. I'll ask the technical team. Okay. Okay, I'll look into it. Don't worry. So I was saying about these phases in the bull market, right? We can identify three phases: accumulation phase, market participation phase, and the excess phase. Informed investors are looking to enter at this phase, right? So I'm going to just mark this phase as the entry and this phase as the exit. So usually the institutional buyers are not going to enter at this phase, okay? Only the retail investors are the ones who are entering at this phase. But they will be trapped afterward because then the price will collapse, or the price will drop back again, or maybe even start a bear market. Here actually it has started a downtrend up from this point, because this market structure has broken down. You might not understand what I'm telling you right now, but it's okay, because we are going to do this trend reversal learning thing on the next session. So it's okay if you don't understand, but it has started a downtrend after this point. So this can be leading to our bear market phase on gold after this peak. So what I'm trying to analyze right now is the bull market phase, and we are identifying these three phases on the bull market. I hope that is clear. This accumulation phase is where the market has no interest at all. The market participation phase is where the
Yes, can I have a question? Hello.
yes.
The accumulation phase, you mentioned the institute, they are because of the information, they
Yes.
reap well before the excess phase.
Yes.
Then if there's any information limitation I'm talking about the Sri Lankan context, is this an insider information, or why retail investors can't get that information, or due to their lack of knowledge or technical analysis, or what is the reason behind this?
Okay, so so inside information thing, we are not going to discuss it here. Anyway, the accumulation phase is, you can identify that in a chart, because the market usually have a sideways action for a long time, and we are talking about the human emotions. At this phase, the market has no interest, right? When the price is going down, the market is interested because market is panic selling. When the price is going up, market is always interested because the news are coming in every day that this has moved this much, the Colombo stock exchange has performed this much, and that's where the public get interested and enter the market, right? But in accumulation phase, no one is interested. But informed investors, usually the institutional investors, starting to accumulate from this point, right? Because it's just the human behavior. It's a good time to accumulate before the market moves, going to make its next move. So the information limitation, so as our fundamental assumption here is that the share price is always reflective of the publicly available information, right? We are not talking about inside information. So this is not actually just because of insider things. It is just the human nature. When the market is less interested, the price is moving sideways, and usually retail investors are not entering at this point. You get what I'm saying?
So after the
You know,
accumulation, the market can go down as well, isn't it?
Yeah, we'll discuss in the bear market situation, right? So that's why we identify the trend first, right? That's why I said this is my bull market. This is my primary trend,
Yeah,
which
but
is an
we don't
uptrend.
know until the markets move, isn't it? So in the accumulation phase, we don't know if this is a
So
bull
you,
market or bear market, isn't it? How do we identify that?
yeah, how we can identify that is identify the trends. So I told you guys earlier before, a trend, an uptrend is where the market is making higher highs, higher lows, higher highs, higher lows, higher highs, higher lows
Yeah,
again.
I
And here,
I
I'm getting to
understand
that.
that, sir. But we
Yeah.
are checking the past chart now, right? If you're on the
Yeah.
accumulation phase, so we don't know what is that bull market or bear market in the future, isn't? We're not gonna have this future
Yeah.
chart, right? So how did we identify that it's a bull market or bear market? Because
Yeah.
we are on
So
an
as I told you
accumulation phase.
before,
It's gonna make any high or lows, right? It's gonna trade on a side phase, right?
yeah, right. So again, I'm saying that this is my uptrend, but after that, if you are like a good technical analyst, you might see this is an starting of a downtrend because the trend was reversed from this point. But I'm not going to explain it now because we have a separate session covering on the trend reversals. After this phase, I'm actually seeing a trend reversal because the market structure has changed. We have different, different concepts. When discussing that, I'll just tell you now since you have asked the question. So I'm just saying this gold has started a downtrend and maybe it will lead us to a bear market. So how I say that is, right? So I said our uptrend is when the market price is giving higher highs and higher low, right? You can see the higher high, last higher high made here. This is the highest point in our previous trend, right? This is the lowest point that led us to this higher high. So I'm marking this. It's okay if you don't understand how to identify the higher highs and higher lows right now. We'll discuss in detail again because we are covering the trend reversals on next session. So this is the higher low that has led us to this higher high. The basic way of identifying a trend reversal is that market is breaking down from this higher low, right? So you can see the market has closed below this higher low, sorry. I'll just mark it on the chart. This is our higher low and the market has just swept this liquidity here and then again recently closed below this level, right? This previous higher low. Now that's our primary indication of a trend reversal. So we are now starting a downtrend, right? So this is the start. This can be this is not investment advice. Okay, anything I say here is only for educational purposes only. Don't make investment decisions based on what I say. Do your own analysis. Okay, so this might be this might be just by looking at this chart. This is for me. This is a start of a downtrend. So this is our distribution phase in the downtrend. Because I was now talking about this bull market now, let's look at the three phases of a bear market. So in the bear market, the three phases are starting like this. It start with a distribution phase. So you see in a bull market, like after the accumulation phase, right? There's public participation and excess phase, or throughout all these phases, the price is going up. Then again, it start to slow the momentum, and then it will lead to like a sideways action. But if it's a bear market, we call this accumulation phase a distribution phase. So this is our distribution phase. You see this accumulation right here. The price has traded within this range for a few months. Yeah, like this. It doesn't make any like very up or downtrend move, just trading in this range. So if we consider this as our bear market, start of a bear market, I'll just mark it in red because bear market is where the price is going continuously lower and lower. And you see lower highs, lower lows, lower highs, lower lows. That is an downtrend. But it is, if it's going to be a continuous downtrend is a question, right? Anyway, the trend has changed. So this can be a bear market. That's what I'm saying. So this is in a bear market, this accumulation phase is called distribution phase. These are just names. In theory, you don't have to like remember those names. Just you need to be careful and be able to understand the trend right? So the trend has changed now. So we are right now, if this is a bear market, we are likely in the public participation phase from this point. So we will be in a public participation phase in the next couple of months, right? This is just a guess, okay? Based on the available technical facts, I'm just guessing. This is the start of a downtrend, right? Because the market structure has shifted, breaking this higher low, previous higher low. This is called actually a market structure shift, which is a change of character. Does anyone know about ICT? Have you guys heard anything about ICT trading? Just drop a text on Teams chat, on the Zoom chat, if you have heard about ICT. Anyone? In ICT, we call it shock or change of character. This is a classic market structure shift where the trend has reversed from a bullish trend to downtrend. Okay. So I was just going to, we are just going through the second second principle of Dow theory, where we say the market has three phases in the primary trend. Sorry, primary trend has three phases. For now, what you guys can do is just try to understand these core principles. I'm actually guaranteeing you that you will understand, or it will all start to make sense once you progress to some extent in this technical analysis course, because it's not possible for me to give you all the technical understanding in one session, right? So these are just building the basic knowledge to go further in our technical analysis sessions. So for now, if you don't understand anything, that's also okay, because these are like very interconnected technical analysis concepts, and we will be discussing them over and over again, even in next sessions. So it's okay if you don't understand it. Once you are familiar with it, it will make sense, right? Primary, sorry, I forgot what I was going to write. Three phases of these are the three phases of primary trend. In this case, it's a bull market, because market was giving higher highs and higher lows. Do you guys understand the principle? Just remove everything here. After this point, I'm not characterizing this as a uptrend, because it failed to break this higher high. You see, this is my highest point, right? And it failed to break this higher high, and actually it broke this higher low level, and trend has shifted. So up to this point only, we can consider it as the bull market. That's why I'm not considering this part as the bull market. Okay. So in a bull market, the three phases are accumulation, market participation, and the excess phase. As informed investors, we should always try to enter at this point. Our entry is the accumulation phase in a bull market. Our exit point is the excess phase in a bull market. So to identify the actual exit point, you need to know the exit rules, right? That means you need to know that the trend has changed. That we will discuss at a later point when we discuss about the trend reversals. Okay, for now, just understand these basic concepts. There are three phases of primary trend: accumulation, market participation phase, and excess. I know this can be a lot, but don't worry if you don't understand anything. It will make sense once you know enough about the technical analysis. Okay, so I'm not going to draw the bull bear market phases because we have like very limited time. We have about 1 hour more. So I'm not going to draw the primary phases, sorry, the phases in a bear market. Anyway, it's same as this, but the opposite. We have 3 phases in a bull market, sorry, bear market: distribution, public participation, panic phase. Distribution is where we see an accumulation like this point, right? And in this accumulation phase, when you also identify the trend reversal, that can be also our exit point, right? It is so usually this both can be our exit point depending on the risk tolerance of the investor. So if you feel like you have, so if you are an informed investor, you might have entered at this accumulation point, right? So if your risk tolerance is low, you might feel now this profit level is enough for me. So you can exit at this excess phase, or you can exit after you confirm this trend reversal right here. So this distribution phase in the bear market can also be your exit point, or if your risk tolerance is low, this can also be your exit point. Right? There's no right or wrong answers. These are very subjective things, but the theoretical and the technical things are to identify this trend reversal right here, which we will discuss later. Right? So in bear market, let's try to see a bear market. I don't think gold has a bear market. We need to identify a primary trend where the primary downtrend where the gold has continuously gone down for about 2 years or 3 years. Okay, I don't think we can find it on gold. We look at Bitcoin. Okay. November 2021, December 2022. Okay. This is the bear market. Our primary trend is down. It is continuously giving lower lows, low highs. I'll just mark the path. Lower low, higher low, lower low, higher low, lower low, another higher low, lower low, higher low, lower low. Like this, it has been continuously giving downtrend vibes, and it has been in a downtrend from 2021 December to 2022 December, right? So this is our primary trend, which is a downtrend. Now I'm marking our bear market, right? This is my bear market for Bitcoin. Right? And we can identify our 3 phases of the bear market. I'm going to delete this. So this can be our distribution phase, where you see the price is trading sideways. Here, from here, the price is making trading in the same price range for about 2 months. That is our distribution phase. This is where the market is not much interested because the price is trading at the same range. Then we starting to see the public participation phase. Now the news is starting to broke out that the Bitcoin has gone down by 20%, right? Bitcoin has started to go down by 10%, right? Like that, we see news coming out, and that's usually the market participation phase. That's where the people, usually the retail investors are starting to sell, because for informed investors, this is the point where they can fully exit the market, because the trend has reversed. If you look at from here, the trend has reversed from this point, right? And it feels like it's going to start the downtrend. That's when the informed decision makers or the investors starting to sell their position. So in this market participation phase is where usually the retail traders is starting to sell. Okay, you can also call this public participation phase. Public participation phase. And this can be a panic selling here. The price action, the price is coming down more broadly and very quickly during the panic selling. This is a panic selling. You know, this point, from this point to this point, the price action was like not very quickly coming down, right? It is been trading for at the same range for some time. Then from at this point, the price is coming down very quickly. That's panic selling. Like this here, you see the public participation phase, then the panic phase. Again, we are going to start to go for a accumulation phase. This is our accumulation phase. You see again here. These have both bear market and bull market. We can analyze it very easily, right? This is an accumulation phase again. Where the market is like trading in a very certain price range from 23,000 to 15,000. It has been trading there for a long time, and this is where the market has like very minimal, interest in Bitcoin, because the Bitcoin has hit 15,000 in 2022. No one is interested in buying, right? So that's our accumulation phase. Again, we are going into a public participation phase when the Bitcoin has gone up from this phase, right? Let's mark it to this point. This could be a public participation phase. Then again, this can be a excess phase. Here we have seen like a lot of broader, price movement up to this point. So this is also an accumulation after this point right here. This was also an accumulation phase, right? And again, from this point only, we started to see broad price movement. So we can actually consider this as our accumulation phase. This is also a good point to enter, because still you can catch like, about 380% return if you enter at this point, this accumulation phase. If you could have entered at like this accumulation phase, it would be around 630% gain until you see this trend reversals. Here also we see a trend reversal. Right. So the basic thing what you need to understand here are the three phases of bull market and bear market. So these are all very subjective and based on human emotions, right? And it can, there's no right or wrong way you can actually draw these things. These are very subjective but very important theoretical concepts. There's a extent this can be helpful in real trading, but still you need to understand these basic concepts before we move on to more, the modern concepts. So I hope that the second tenet is also clear. Are there any questions? Any questions, guys? And one more thing in these sessions, if you miss one of this session, please try to watch the previous session before coming into the next session. Otherwise, you will miss a lot of important stuff, and you might not understand what I'm saying in the next session. If that's the case, that would be a problem. So please always try to watch the previous session before coming into the next session. Okay, so we'll move to the third principle in the Dow theory. I guess up to this point, it should be clear, right? There are three market movements, which is the primary trend, secondary trend, and within the secondary trend, we see minor trends. And the second principle is there are three phases in a primary trend, both in bull market and both in bear market. The principle, I mean, the key thing what you need to understand here is to identify the bull and bear market, right? If that's clear, then you are good to go. Okay. Third one is also one of the assumptions we discussed earlier. So it says that the market discounts all information. It was our fundamental assumption in technical analysis, right? Market price reflects all publicly available information. That means the price is reflective of everything that's happening in the market, what's happening in the economy, what's happening in the global context, and the company itself. If you are looking at a particular company like NDB, the price reflects that it has gone through a fraud and it's currently under pressure, and all the publicly available information is reflective of this current market price of NDB stock, which is 109.5. Right now it's trading at 109.5. Previously, before the fraud, it was trading at 130. It has come down by about 17%, reflecting the fraud that has happened. 13 billion fraud, right? So I guess you must understand this third principle, right? So we'll move to the fourth one, which is indices must confirm each other. So this thing can be less relevant in today's modern market, but still as way to understand this principle, as a way to understand this concept, you need to know what this means. So this basically in the 1850s, this Charles H. Dow saw a correlation between the industrial markets and the materials market, actually the transportation market. So he is actually the father of Dow Jones Industrial Average. He has created the Dow Jones Industrial Average. I'll just show you guys it. Wait. Dow Jones Industrial Average. So this is one of the most important index in the US that show the largest 30 industrial companies average moving price. It's like the S&P SL20 in Sri Lanka. But in Dow Jones Industrial Average, it shows the largest 30 companies, 30 industrial companies like Nvidia, Apple, JP Morgan Chase. So these are the companies that makes this Dow Jones Industrial Average. So this is also an index like SPI, S&P, SL20. This is also an index. Okay. So this was created by this was first created by Charles H. Dow, who was the who first came out with this Dow Jones theory, Dow theory. So what he's saying is that the indices move together. By indices, what he means is this. So this might be a little difficult for you to understand, but it's okay. I'm going to just show this to you. So this Dow Jones Industrial Average, what he says is that this consists of the 30 largest industrial companies in the US, and it will move along with the Dow Jones Transportation Average. So this is these are two different indexes. Wait, I can use this right here. So there are two indices. One is DJIA, which is the Dow Jones Industrial Average. The other one is the Dow Jones Transportation Average. What this principle says is that when the Dow Jones Transportation Average move in a certain direction, Dow Jones Industrial Average should also move into the same direction, because Dow Jones Transportation Average shows the companies that are in the transportation sector, right? So his argument was that in order for the industrial sector to perform well, the transportation sector must perform well before the industrial sector, because industrial sector do a lot of manufacturing, right? That for that manufacturing, they need the materials, and they need the material transferred to different locations, right? So that means there need to be an uptick in the transportation side of things. That transportation activity will increase. So the transportation activity increases means there will be an increase in the manufacturing activities. Now you see the connection between those two, right? Material need to be transferred in order to industrials to do the manufacturing and perform better. So if the Dow Jones Transportation Average goes up, that means more materials are transferred, and there will be an uptick in the industrial sector as well. By that mean, DJI will also go up. So if DJTA goes up, DJIA will also go up. If the DJTA goes down, DJIA will also go down. So let's look at the indicators first. So I'm going to go to the charts again. I'm changing this to line chart. So right now what we are looking at the Dow Jones Industrial Average. I'm going to get rid of this volume indicator. Right? I'm going to add DJTA. We'll mark it in red. I think it's better if we add the DJTA first. DJTA. Okay, so DJIA is the red color line, right? DJTA is this purple color line. You see the correlation between these two. When the DJIA goes down, DJTA also goes down, right? I'll just mark it by arrows here. red color one is the DJIA, which is the Dow Jones Industrial Average. And the blue color or the purple color one, I think it's blue. I don't know, maybe blue, is also going down, right? And this is when this is going up, the transportation, transportation average is also going up like that. So these two indices are correlated, very closely correlated. So what this concept or the theory suggests is that these two move in the same direction because the materials that are transported are related to the manufacturing and the industrial sector stocks. So this DJTA or the blue color one shows material industry, material transportation, we will say just material transportation. So it's going up. That means the transportation companies are doing well, their stocks are doing well. That means the material transportation activities are going up, right? That also means this industrial activities should also go up. Industry, industry manufacturing. Yeah, let's say just industry manufacturing. This is the DJIA, Dow Jones Industrial Average. So DJIA has the stocks that are in the manufacturing or the industrial sector. Few examples are Nvidia, Apple. All of these companies are represented in the DJIA. I'll also type in some examples. DJIA includes Apple, Nvidia. I don't know. This is probably the right ticker. Like those companies are included in this DJIA. In the transportation average, there are companies like FedEx and like a lot of airlines, FedEx. I don't remember the exact companies, but you can, do your research on that. A lot of airline companies are here, airline stocks. Just don't mind about the spelling, so it can be wrong. R is missing here. Right? So these companies are represented in the DJTA. So what we are basically seeing is a correlation between the material transportation and industry manufacturing. When the material transportation activities are up, it means this industrial activity will also go up, right? So this concept is only applicable to indices where we see a correlation. So if you look at like two indexes that are not correlated at all, this doesn't make sense. Okay. Right. So we'll try to also look at an example from Sri Lanka. Do you guys know any sector related indices? So the primary index we have is the ASPL, which is ASI. Right. This is ASI. So I can argue in order to let's go to S&P SL20. S&P SL20. Okay. So this S&P SL20, I hope you guys know what does this mean. So this index is the 20 largest companies traded in the Sri Lankan stock market. You can actually view those companies by just searching here. We search S&P SL20. Okay, so these are the components of the S&P SL20. These are like the 20 largest companies that are traded on the Colombo Stock Exchange, right? So I'm arguing that in order for these companies to perform, there need to be an uptick in the energy sector, because higher energy consumption means there will be higher manufacturing activity, right? So do you guys agree with my argument? If there's higher consumption in energy, there will be a higher performance in the S&P SL20. That's my argument. Let's test that argument and see. So I'm going to look at S&P SL20. That is our primary index. I don't remember the sector related indexes. Just wait until I find out. I think I saved it somewhere. Okay, so there are like 20 industry groups and price indices like this. So I'm going to look at the energy sector. Where is energy? Here. So this is the ticker that's represented in the energy sector stocks in the Sri Lankan stock market. Here, S&P CSE Energy Industry Group Index. So by clicking this, I'm adding this index to our chart. So this is our energy chart. My primary argument is that if energy index go up, largest 20 companies stocks will also go up. Why? Because higher energy consumption means higher manufacturing activities, higher economic activity, all that sort of thing, right? Let's see. We'll also add S&P SL20 to this chart. Yeah. Now you guys can see the correlation, right? When the energy index is all going up, S&P SL20 is also going up. So my argument holds true. I'll just mark the path. I'm just changing this to red color. Right. Red color is S&P SL20. Yeah, this is S&P SL20. This is our energy index. You can see here, right? When the energy sector goes down, largest companies' prices also go down. Stock prices go down. When it goes up, right, the energy sector is going up, the largest 20 companies will also go up. Right? You see the correlation, right? So there's like very close relationship between those indexes. Okay, the format messed up. That's okay. Okay, so this is our fourth principle in Dow theory. Indices must move together, but these indices should be closely related one. For example, like the first example I gave you, which is if the material transportation sector is picking up, that could mean the industrial stocks are also going to pick up, right? Those should be closely correlated, and there should be reasonable justification behind that. So this might not always work in the modern market, right? You have also need to identify the closely correlated indices for this, for you to test this assumption, for you to test this principle, right? I'm going back again to our presentation. So I was saying, just read through this. Dow argued that Dow Jones Industrial Average and Dow Jones Transportation Average should confirm the same trend direction. Right? That means if the Dow Jones Transportation Average picks up, this should, that will be an indication that the industrial average will also go up. Right? If one index reaches new highs while the other fails to confirm the signal. So this is the divergence. This concept is the divergence. It will be somewhat difficult to explain it, but I will explain that through this chart. Right? A divergence, just pay close attention to this. A divergence means when two things are moving different directions, right? When two things are moving in different directions, when they normally move in the same directions together, right? By that, what I mean is when the Dow Jones Industrial Average goes up, DJT goes up, that means DJIA will also go up. When the Dow Jones the transportation average goes down, that means DJI will also go down. But when the Dow Jones Industrial Transportation Average goes up and DJIA goes down, that's the divergence. Those are like opposite directions, right? Here, look at what happened. Here you see from this point to this point, DJT has gone down. It has failed to make a new high from this point. I'm pointing to this exact point, right? After this point, it didn't make a higher high. It made a lower high to this point, right? And look at what happened in the DJIA at the corresponding date. Corresponding by means exact same date. In the DJIA, the market has made a higher high. I mean, it looks like a equal high, but if you look at closely, you can see it has made a higher high from this point to this point. These 2 points, right? This point, it's a lower high. This point is a higher high, or you can say it's a equal high, whereas DJT made a lower high. So what does that mean? That's a indication of a potential trend reversal. That means the DJT has gone down, which means the material transportation sector is not doing well, but DJIA has been doing well. It doesn't make sense, right? So that means a divergence. There can be a potential trend reversal. So look at what happened after this point. DJIA has gone down. DJIA has collapsed, right? So this is one of the indication of a trend reversal where we see a divergence. I mean, if you don't understand the divergence as of yet, that's okay, because we will be talking this divergence many more times. We will look at volume divergences, we will look at RSI divergences. There are divergences all over the technical analysis course. So you will understand it better when we discuss about volume divergences. So it's okay if you can't actually, understand this concept right now. But this is what we call a divergence. Usually when the DJT moves up, that means DJIA also should move up. When the DJT goes down, DJIA also goes down. But when the DJT goes down and DJIA goes up, that's a divergence. This is a divergence. DJT goes down, DJIA goes up. It can't be, no? It's a divergence. So that's our primary, not primary. This is an also indication of a trend reversal. This is our exit signal. This is an indication of the trend reversal that we can potentially use in from the Dow theory, right? So that's what we have discussed as our fourth principle. Indices must confirm each other, right? Usually indices move together. When there's divergence, that is potentially signaling us a trend reversal. So there are a lot of ways to identify trend reversals. This is just one of them. We don't actually have use it because in modern markets it's like very hard to identify where the two indices are closely correlated, right? But there are markets where you can see very correlated indices and you can use this concept. Especially in gold, you can actually look at the US dollar index, because US dollar index and gold is inversely related. They're actually moving in the opposite directions together, right? So this principle is very important when it comes to gold trading. But in local context, it's just the one I found by using this energy index and the S&P SL20. There can be many more. I mean, you can do your own research on it, but it's like there are like very limited application of this fourth principle. Anyway, I hope you guys understood this. Just if you have any questions, just let me know. Any questions so far? Any questions, guys? Is it very difficult to understand? Or what do you feel?
So the transportation matter, the two indices you have shown in divergent things. Is this a volume consumption, not related to the inflation interlink for that graph, sir? There is purely increase in consumption, no? Regardless of the price hike.
Yeah, this is actually on the price side, because DJTA means that it represents the largest transportation companies' share prices, right? DJT represent share prices of the largest, I don't remember the exact amount, but they are the largest transportation companies' share prices. So this is like a same like ASPI. So ASPI is a weighted average price of all the shares that are traded on the stock exchange now. So DJTA is a weighted average price of all the not all the transportation, like the largest transportation companies. On the other hand, DJIA is the share prices, the moving average, the weighted average share prices of the largest 30 industrial companies. So these are share prices, but it's an index, right? DJIA is an index, same as ASPI and same as S&P SL20, and DJTA is also an index. So these indices represent share prices. So the basic assumption here is that when the material transportation are doing better, that is reflective of their share prices. Let's say we are seeing a lot of transportation activity in the market. That means the transportation companies are generating more revenue, right? And that is reflecting in their financial statements. And when it represented in their financial statement and it translates into profits, it's also reflective of their share prices. Do you understand the connection here? So everything that are publicly available is reflective of the share prices. And that basically means if the transportation sector is doing well, it's represented by their share prices going up, and it will also translate into the material sector's performance. Okay. I mean, if you can't really understand anything what I'm saying, I mean, we are going to go through every one of these concepts again when we discuss about the trend reversals, all of these things, and when we are looking at the indicators like RSI, we also come across these divergence things. So it's okay if you don't really understand this divergence and if you don't really know how to use it, because next we are also going to look at the volume divergence. So if just ask me if there are any questions up to now. I mean, if you can't unmute yourself and talk, just drop a message on the chat. I mean, there's no easy way putting it. The technical analysis is somewhat complex. So you will have to put some effort from your side as well. By that I mean you have to use TradingView. You have to study the market behavior along with the technical concepts we discuss here. So there will be 8 sessions now. So I will be covering a lot of technical analysis stuff that would be useful to become profitable traders. And if you are like going to be registered investment advisors, that would be very useful to analyze the market behavior along with the fundamental side. So the fundamental analysis can be it can be easier to learn because it's those are like very familiar stuff, just looking at the financials and all of that sort of thing. But here what we are studying is the real market behavior. So it changes from time to time. The interpretations are different from one person to another person. So it can be somewhat difficult, right? It's not your fault. It's how it is. So that's okay. And also try to watch the session again next time you join. Before the next session, just watch the recorded sessions again. I will share the presentations and the recordings both. Okay, so we'll move to the fifth one. Fifth principle is that volume confirms the trend. So this is also somewhat like a correlation we looked at earlier between two indices. But here what we are looking at the correlation between the price and the volume, right? What we basically say here is that when the price goes up, volume goes up. When the price goes down, that is reflected by the decreasing volume. So now I'm going back to the charts again. Okay, any preferred tickers for you guys? Just drop a message if you want me to look at any ticker, any particular ticker. So right now I'm looking at the S&P SL20. I'm going to add volume indicator. On TradingView, you can add volume indicator from this indicator section here. Right, I'm selecting this and I'm adding volume indicator. For Sri Lankan indices, you can only get the volume indicator from AirTrade. I think here I will not be able to look at the volume. Yeah, volume indicator is not available for indices on TradingView. So I'll look at Bitcoin maybe, or else commercial bank. I'm adding the volume indicator. Okay. So below here, you see the volume indicator. Okay. So this is by the green or red candles. It doesn't mean anything. Okay. So this is just the total volume traded at that point. It can be buying volume. It can be selling volume. Actually, it's the net, not net. It's the total trading volume. The red candle doesn't mean it's just the selling volume. This is the total volume traded at this point. Okay. So our fifth principle is that volume confirms the trend. Volume is also moving with the price, right? When the volume when the market price is going up, that is reflected by the volume. So from here to here, you see the market price has gone up, and it's also reflected in the volume going up. From I'm looking at the corresponding volume from this point to this point, right? When the market price rallies, the volume also expanding. When the market price tanking like this, that can be also confirmed by the expanding volume. So this is just the way market behaves. But how can we use to signal our entry or exit? It's the divergence, right? We also look at the volume divergence. So volume divergence is also another different thing. Volume divergence means usually how the volume moves in a strong uptrend where the price goes up. That means volumes also expanding. Volume goes up. Okay. When the price is in a strong downtrend and the price goes down, volume should also go down. If this happens other way around, that means a divergence. Volume divergence is when the price goes up, the volume doesn't go up, it can go down, or maybe stay at the same range. Volume goes down. Let's say volume does not go up. When the price goes down, volume does not go down. So this is the usual way, normal situation. In normal situation, is like this. Volume goes up, the price goes up, volume goes up. The price goes down. Sorry. So this is when the price goes down. In a downtrend, in a strong downtrend, when the price goes down, volume should always go up. Sorry, here I have mistaken it. Right, volume goes up in both situations because this is not just selling volume. Right, the volume represent both the buying and selling volume. So in a strong downtrends, volume also go up when the price goes down. Right, when the price goes up, volume does not go up. Right, that's correct. The divergence is when the price goes up, volume does not go up, and when the price goes down, again volume does not go up. We'll look at some examples, then you'll understand. Okay, so this divergence part is where you might get confused. So this normal situation you should understand, right? When the price goes up, usually it has to be followed by higher volume. When the price goes down very strongly, it also need to be accompanied by higher volume. The divergence is something like this. look at the price chart here, increasing volume, right? This from this point to this point, you see the price chart, right? Price has gone up from this point to this point. Wait, I'll zoom in. From this point to this point, price has gone up. But look at the volume. Volume has gone down. That's a divergence. So what does that tell us? This divergence, what does that tell us? It signals us a trend reversal. What is the current trend? Current trend is an uptrend. The price is making higher highs and higher lows, right? It's an uptrend. So the price is going up. It should usually reflected in the increasing volume, but from this point, price is going up without volume expanding. That means a divergence, and it signals as a potential reversal. So from that point, you can see the prices has started to coming down, right? Trend has reversed. So that is also the signal that we can get from the volume indicator, which is very important. It's the volume divergence, right? This is also true in the bear market, which is not bear market. This is also true in the downtrends as well, right? We have few more. We have about 10 more minutes left, so I don't think I'll be able to explain it in a downtrend situation, but I will actually, briefly discuss all the 6 principles again in the next session before we move on to the new session. But for now, I'm just trying to explain it using this, the uptrend chart and explain the volume divergence in this uptrend chart. Okay, we'll look at a situation in the real world for a volume divergence where we see a volume divergence. Just keep it here. Oh, thank you. I'm just trying to look at a volume divergence, right? In this Combank chart. Give me a few seconds, guys. Okay, look at here. You see in Combank chart, this is just one example. You can actually try to see this on charts from by yourself as well. But look at this point, right? You see a higher high, right? The price has gone up from 231 to 232 from 16th of February to 18th of February. So the price has gone up. But if you look at the corresponding volume during these 2 days has gone down from this point to this point, right? Just look at the corresponding volume and the price here and here. You see the divergence. Price has gone up, volume has gone down. This is a divergence. This signals as a trend reversal. And look at what the price has reacted, how the price has reacted. After that divergence, it's a trend reversal. So this type of divergence is called bearish volume divergence. But you don't need to remember all these, the technical words at this point. But just remember, this is a divergence where the market is not moving in the way that it is supposed to. So usually when the price is going up, like from this point to this point, you see the volume has gone up. Look at this point. From like this point, let's draw a vertical line. You see here the volume is going up and the price is going up. That's the usual way, right? This is a strong trend. So when the price is going up and the volume is going down, that gives us a signal that the market is diverging, right? And if you look at from this point also, you see this volume going down. I'll just mark it here. You can see here, from here, the volume is going down, but the price is going up. I mean, let's mark it until here. So you see the, the price, right, going up. Volume going down. That's our divergence. That signal us the potential trend reversal. Also, we look at the divergence in the other way around. So when usually the price is also going down, the volume should go up, right? Like this point. The price is going down from this point to this point. I'll also mark it here, usual way. Price goes up, volume goes up. Look at from this point to this point. Or look at from this point. The price has gone down. The volume has gone up. So that's the usual way. When in strong downtrends, when the price goes down, volume also expands. Here also, when in a uptrend, when the price goes up, volume also expands. Right? This is the usual way. Here also the usual way. But when it happens the other way around, that's a divergence. That signals us a potential trend reversal. So let's try to identify it here. Yeah, you can look at here and also see that, but let's try to identify a clear one. It's not clear. Let's look at the bottom. And okay, here also you can see that I think, no, not from here to here, but from here to, no. Price going down, volume going up. That's the normal way. Price going up, price going down, volume expanding, price going down. Here there is some, no, it's not there. Okay, here, look from this point to this point. The price has gone down, but the volume did not expand. Volume has also gone down, has gone down. Right? That's our divergence. Here, usually in a downtrend, not in downtrend, when usually the price is making a going down in a more strong manner, the volume should also expand, right? But here, if you look at the volume chart, the volume has gone down. Wait. Okay, I have. It should be actually volume go. Let's go down. Yeah, I have changed this earlier, but I couldn't change it here. I know it might be confusing for you. So for now, just understand this divergence in the, the uptrend. So usually it can be confusing in the downtrend, but in an uptrend, it's clear, right? So in an uptrend, when the price going up, usually it has to be followed by a increase in volume. But when the price goes up, and the volume does not follow that suit and goes down, that's the divergence. I'll explain the divergence, volume divergence in the downtrend again when I find a good example. For now, just remember, this is the divergence we are talking about in a uptrend, right? So we have few more things to cover, like the limitations and the sixth principle. So this sixth principle is all about the trend, and we will discuss the trend, everything about trend in the next session. But up to this point, do you have any questions? I'll wind up these sessions in a bit. So if you guys have any questions, just let me know. I also have an activity for you guys. I will share the presentation and you guys can try this activity when you are free. It will not take a lot of time. What you have to do is you have to identify a interesting stock for you, right? Any indicator or any particular stock. I'm not like, I'm not giving marks or anything, but this is for you to try by your own. What you have to do is you need to get a price chart first. What you have to first do is making a trading view account, then look at a market index covering about 5 years of data, right? Then identify the label at least one clear primary target, right? And identify two secondary reactions. So I'll give you an example for this. So what I'm saying is I'm going to select HNB, right? HNB.N. So if you have like selected this stock, you would first need to identify the primary trend. In my chart, what is the primary trend? There's no right or wrong answer, right? Primary trend can be something that is within 1 to 5 year time horizon. So I identify this as my primary target. So just mark this primary target like this and just say primary target. And within this primary target, you have to identify the secondary. So primary trend. Within this primary trend, you have to identify the secondary trends like this one. Just mark few. Secondary trend is also a secondary thing. Then what we have to do is you have to identify the accumulation, public participation, and the panic selling or the excess sales. So if your primary trend is an uptrend, the three phases are these three. So I try to identify these three phases within the primary trend, right? And you have to also mark the volume behavior. No, we don't need this. We'll discuss the volume divergence again in the next session. So until that, you have to, identify this accumulation, public participation, and excess phase. In my case, I will mark it like this. Just give me a few minutes, it won't take much long. So this will be my accumulation phase. I'm marking this as accumulation. My primary target will be this. Primary trend would be this. This is my accumulation. This is public participation phase. This would be my excess. I'm going to share this with you on the chat. Download this. You guys can see it's loading. You guys can see my image on the chat box, right? So I expect you to try something like this on your own. I will be not giving any marks or anything. Just try it on your own, and we'll discuss more in the next session about the volume divergences and the trend reversals. So I will be covering these parts in the about the trends, support, resistance, and volume divergence. I will cover those things in the next session. So I'll see you on next Saturday. Thank you for you to join the session. If you didn't understand anything, just don't worry, because we will be going through this again. Okay then. See you guys.
Thank you. Thank you.
Thank you.
Thank you.
Thank you.